with good, strong regulation, with a rise in interest, the future of the Indian debt market is indeed promising. While issuance of conventional bonds continues, what we're now seeing is a rise of interest in green bonds, social bonds, yellow bonds, as the citizens of India and the citizens of the world have become more and more aware of the imminent, urgent challenge of climate change. Institutional investors, retail investors are both preferring to invest in green bonds, and issuers are more and more looking towards them to fund eco-friendly projects, ladies and gentlemen. What delighted me recently was to see the government of India join the club in 2023 and issue green bonds worth more than $1 billion across 2 tranches. And given our commitments, COP26, COP27, there's surely going to be a rise in appetite towards investing in sustainable finance, green bonds, yellow bonds, and social bonds. I'm not the expert here. Let's get the experts on stage. I'm so delighted to be inviting her on stage. I watched her on television year after year, being the super expert that she is. Ladies and gentlemen, we at IDCMS are absolutely delighted to have the expertise and the presence of Executive Editor, CNBC, Latha Venkatesh. Put your hands together and welcome her on stage, ladies and gentlemen. She's somebody who's known as one of the keenest observers of the Reserve Bank of India and is a highly respected commentator on matters of the banking sector, money, and macroeconomic trends. She's worked in several streams of media, having served at the Economic Times and Dow Jones Newswires. Once again, delighted to have you here as the moderator of our first panel at IDCMS. Welcome, welcome, welcome. And may I please invite on the dais the esteemed panelists of this first session. Mr. Jayesh Mehta, Managing Director and Country Treasurer, Bank of America, NA, India. Can we please have you on stage, sir? Good morning, sir, and a very warm welcome. Ladies and gentlemen, our esteemed panelists have given us time. We will put our hands together in applause and welcome each and every one of them on stage. Please put your hands together and welcome on stage Mr. Navneet Munat, Managing Director and Chief Executive Officer, HDFC AMC. Very warm welcome to you. Ms. Padmaja Chunduru, Managing Director and Chief Executive Officer, NSDL. Good morning, ma'am. बहुत-बहुत स्वागत है आपका. Very warm welcome. Please put your hands together and welcome on stage Mr. Rajkiran, Managing Director, NaBFID. Good morning, sir. Very warm welcome to you. May I also please invite on stage Mr. K.S. Giridhar, Executive Director, LIC of India. Very, very warm welcome to you, sir. And may I please once again invite on the dais Ms. Nipa Sheth, Founder Director, Trust Group. And now, ladies and gentlemen, I hand the proceedings over to the Honorable Moderator, Latha Venkatesh, for the first panel of the day, Indian Debt Markets Onwards and Upwards.
Indian debt markets, is that fine? Indian debt markets onwards and upwards. I think I cut my teeth in the debt market in the late 90s. This topic would have been relevant then. It would have been relevant in 2005, in 2010, 2015, 2020, and today. Indian debt markets advancement and growth is something like tomorrow. It never arrives. It's something we are always looking forward to. But there are 2 points that I want to put on the table and then go on to the discussion. We will discuss new issues, the IPO market in corporate debt, whether we can move from taking loans to taking money from banks through debt paper. That would be one part, the IPO part, and then trading in bonds. Those are 2 separate issues which we will discuss. Of course, they will intertwine. And the other point that I want to put on the table is the bunch of two new things that are happening in the Indian market. One, the sovereign has become part of a bond index starting June 28th next year. It's obviously only the first of the bond indexes, and it'll be only a matter of time before the Bloomberg index and the other indexes also include. So there is genuinely a huge amount of at least one-time money of anything between 25 and $50 billion that comes into the sovereign paper. What is the impact? The other big inflection point that's happened is probably in anticipation of this, the Reserve Bank has drastically changed the rules of HTM, AFS and HFT. I seek your pardon for the jargon. All Indian paper, all bank investments in bonds are categorized as HTM, held to maturity, the longer term investments, or they are categorized as AFS, available for sale. Normally banks sell it in a couple of years. And then there is HFT, held for trading, which is usually a 90-day thing. The norms have been hugely changed starting April next year. So I want to first begin by asking whether these two elements are enough to take the Indian bond market onwards and upwards as Trust Mutual Fund sees it. Let me start with one of the senior most bankers here. Okay, we have two of them. So I'm going to start with you, Mr. Rai, since you're still, in a sense, in a bank. The fact that held to maturity until now was, or even now, is only meant for sovereign paper. But now, banks can hold to maturity even a Reliance paper, an Adani paper, a Shriram Finance paper, now an HDFC paper. So much of it was issued earlier this year. Is that going to mean that corporates will issue more bonds rather than take loans, and banks will also see greater interest in holding corporate paper? What is the impact of this move?
Yeah, good morning and thank you. It's a big change because we used to call SLR non-SLR, actually between HTM and AFS basically. Now this non-SLR also can be held in HTM. That is a big change. Why banks avoided investing in corporate debt is basically mark-to-market issues basically. Now with the permission to hold these bonds under HTM category where need not mark-to-market is the biggest enabler. And actually the banks also, the business model is likely to change. Actually banks have to look at bonds as more for interest earning perspective rather than the valuation perspective. So corporate debt is actually definitely giving a yield much better than the G-Secs. And I think this will be a big enabler which for the banks in the coming times. So we will also see a lot of issuances. Actually, since I cannot forget where I come from, the NaBFID infra, we have enough assets today which can hit the bond market. Actually, the supply, because earlier the corporates, if you see the bond market also on the corporate debt side, these are mostly 5-year and below papers. We didn't have enough long-term papers. Now, if you see, the insurance industry is growing. It is more than 50 lakh crores of AUM today. Insurance needs, actually, their liabilities are such, they need long-term bonds, long-term assets. So this is a space where all these infra assets which are coming in, actually, just looking at the data, these InvITs and the REITs, they are already issuing the bonds, and you are having almost 1 lakh crores of only HAM assets which are getting completed in the next 2 years, which will hit the bond market, actually ultimately through the InvIT route. Now, who are the subscribers? Insurance is one, but banks are going to be a big player, and this categorization will help.
Mr. Rai, I'm going to intervene because I'm going to ask you a lot of questions on infrastructure and how you, as the head of NaBFID, will use the Indian savings, drag it into infrastructure projects. But for the moment, I want to stick to this change in rules and whether from April 24, banks will give more loans in the form of bonds rather than loans. So, Mrs. Chunduru, to you, again, wear your hat, not of NSDL, but of a banker that I guess you were for 40 years or 35 years. What is your sense? It is not only that, there is HTM that has been made unlimited. It is also that corporate bonds can be included in HTM. And then you have this massive foreign inflow, which will take away a lot of the sovereign bonds. So, the system has more space for corporate bonds. So can we assume that next year when Trust MF organizes this, we are going to see probably a sizable shift? Do you think that that is bound to happen? And also, if you can assess this LEF structure, the Reserve Bank and SEBI put in the structure that large exposures, 25% incremental money has to be raised from bonds and not from banks. So how will FY25 pan out?
Yeah. Good morning and thank you for this opportunity. As you said, I will wear the hat of the banker but cannot ignore the hat of NSDL, which is in the capital market side. Yeah, but both are aligned. I think this change by RBI is quite far-reaching in terms of making HTM unlimited and also making that corporate bonds can be part of the HTM. But I think we should also see what drives banks towards, whether investing in corporate bonds. I think banks basically in India and across globe also, the funding of the market, the loans are the mainstay of funding any development in the economy even today. The corporate bond market has grown, but I think it has a great potential more than this to grow. There have been several efforts made. Now this HTM, definitely it will attract banks to invest more in the HTM, in the corporate bonds, because that market risk is taken out. There were credit risk and interest rate risk. Now it is only credit risk that they need to manage. That said, and also it can encourage banks to look at the A-rated or, otherwise it was AAA and AA. The investment policies said that. So it would now probably let them also look at, because banks are uniquely placed to know to have the due diligence on the corporates. They definitely, have a better perspective, I should say, not just by rating, but more information maybe. So that I think would bring down the risk ladder of investment for the banks. That said, I think most of the corporate bond issues have happened by NBFCs. And NBFCs have been looking at corporate bond issues more as a refinancing rather than a regular amortization or regular repayment. So for the banks to invest more in corporate bonds means they are buying liquidity, they are getting liquidity risk on the balance sheet, because that would mean that they would be spending a lot of money at one go and also getting a lot of money. That, phasing out of liquidity may not happen as much. The other thing is for banks, again, the loan book provides a cushion in terms of 30 days, SMA 01, reporting a default, whereas in a bond market, it is 1 day default. And that makes a little difference. So there are things beyond HTM. I think there are many more issues. Basically, I think the alignment between loans and bonds, that basic structure we need to address, which I think from NSDL side, I cannot help, like he said, NaBFID, I cannot ignore the steps we have taken. In NSDL, we have the India Info Bond platform, which provides data. The other one is that we have implemented a security and covenant monitoring platform on blockchain, and that is operational now. That is SEBI initiative implemented by NSDL. That provides the investors a much more transparent and clear idea about whether the corporates are really, aligning or complying with the covenants. I think that sort of transparency will bring in more participation, both from banks and retail also.
So I am coming with a lot of questions on how regulators and market intermediaries like NSDL and NSE and the exchanges can do to expand the bond markets, both in terms of primary and secondary issuances. But let me get to NIPA on the matter. NIPA, the trust organizers gave us some very useful data on how, corporate issuances, 44 lakh crore outstanding, about 9 lakh crore incremental issuance. Whether you looked at 2016, 17 or 23, it continues to be about 15% of GDP. Mrs. Chunduru, although she's not a banker for the last couple of years, still correctly pointed out that 70% of the issuance is from NBFCs, and now the new rules may make banks wary of giving more money to NBFCs. So in the next 1 year, Do you see the new rules of unlimited HTM, corporate bonds, and FII participation in sovereign bonds increasing the number of, increasing this percentage from 15 to 16, 17, or not yet?
So, though the number seems to be very static, but last 2-3 years, if you see the growth of the overall, the lending which has happened, which is personal versus corporate, what we realized when we looked at certain data, and recently in one of the conferences, Chairperson SEBI also mentioned that the incremental lending to corporate versus incremental bond issuances by corporate actually is higher than the lending. So if you actually put a lending of retail section aside and see lending to the corporate sector versus lending to the issuance of bond market, the bond market is actually growing in terms of steadily growing. Though the GDP is of course growing and a lot of retail loan has happened, but I think there is a lot of infrastructure changes which is happening in debt market, slowly but steady. And I think in last 3 years, we've seen small changes which will actually, when come together, one of them which she mentioned about the blockchain technology for security creation. Second is the HTM piece. Third is the backstop arrangement which government, has introduced, SEBI's introduced. And also the repo. And I think all together, definitely will incentivize a lot of, investors also to come to the corporate debt market. And I think issuer will also find it easier to issue the corporate. So we definitely see, a couple of % increase over the next 1 to 2 years, if not more.
Well, let me come to Mr. Giridhar on that point. The corporate access to corporate bond markets have been restricted to at the most AA. It's not gone below that. What are your thoughts? You will be in a position where you are going to have to buy more and more corporate paper simply because insurance is one of the fastest growing corpuses of money. Do you see that access available to A companies or lower?
Good morning. Yeah. One is, I'll take insurance companies and EPFO and NPS for the convenience because we all belong to one tribe from the requirement side and from the regulation side. Okay, one is mostly we have to follow AA and above from the regulation side, but a certain percentage we can go below AA also. Okay. There what matters is the kind of a covenants, the security aspect and how we can liquidate in case of any default or distress. So this mechanism play a vital role. So earlier it is basically a part of the project finance which we used to have a consortium kind of thing, only insurance companies used to have, but not NPS and EPFO obviously. But whereas when it comes to insurance companies, of late we have not been a part of the consortiums so far. Okay. So we are standalone NCD players, long-term NCD players. We look for very long-term like 15 years, 20 years kind of a thing. Now, see, we are also coming into the Ind AS part, okay? So the same, that unlimited HTM says. So we have to declare in the beginning AFS and HFT portfolios. So that will help us also. Because we don't need to dispose within 90 days and we can book the profits also into the P&L. And the AFS part, we can take it to the OCI, we can take it to the reserves and all. It is the first time that we will be getting into that echo, so that we have to really watch and wait. So here coming to the papers, the specific question of below AA. Okay. So it is basically a higher level call, but it is, yes, we are open to that. If it is an infra kind of a thing, and where it is backed by a solid assets and where the revenue flows are there, it is a diligence call basically. Otherwise, insurance companies are open to this.
No, this new SEBI debenture trustee rules, will that in any way open access?
Yeah, that will certainly help because now, earlier what's happening, so the liquidation issues, if at all, there's a lot of delay in, one is the delay part, second is the haircut, whatever we say, that these are the main issues. I think the recent regulations to some extent it will bring in some kind of confidence in us, it's a confidence matters. So we have certain funds where we can take, certainly we can take an exposure towards this. And the recent SEBI regulations would certainly help in bringing that necessary confidence in going below the AA papers. As Mr. Roy rightly was saying, that it's not only for the valuation purpose, basically, we have to earn more. Otherwise, the investor who comes to us, he expects more than what a GSEC return is, obviously. So the GSEC return comes only when we go into the corporate papers. And we have to make the standard provisions. So a AAA paper, less of a standard provision, will not give a yield which is more than the GSEC, because most of the AAA papers are GSEC plus 40 kind of a papers they get traded. So I think it is inevitable for us to come to AA plus and AA, if need be, maybe AA minus companies. I'm not really sure below A plus. But otherwise, certainly, yes, there is a ground for AA minus.
Now, I will come to the IPO part a little later. Let me get to the retail and the trading part and follow up with more questions on whether more corporate debt IPOs will happen and whether we will progress from loans to bonds. Let me come to the trading part and the retail part. Navneet, one of the problems confronting is the new change in taxation rules for debt MFs. Of course, debt MFs in March of 2023 made enough money, which they would have made in all of 23-24 because of the impending change in rules from April 1st. But how do you increase the corpus? What was your ask be for more debt MF corpus?
Sure. So, as someone who has spent a good part of life as a bond trader and a bond fund manager, it's good to see a debt market conference which is as big, bold and beautiful in size, style and scale as equity market. I feel very happy. And I think compliments to Trust Group, and I think bond markets have only one way to go, which is onward and upward from here on. And it's interesting when people talk about how to develop the retail interest in the bond market in India. I started my career exactly 30 years back, and that time the discussion was, how do we develop the wholesale market in bond? Because the retail market was thriving. I started career as like a market maker in bonds. So from, Hindalco, Grasim, Indian Rayon, Tisco, Telco, Arvind Mills, even a Ballarpur, JCT, several names. I will give two-way quote on like 20 bonds continuously.
Then what went wrong?
And that was a time when actually you had physical security. There were hardly any reporting platform for secondary market. There was no bidding platform. There was no repo market. There was no derivatives market and all of that. And the discussion was, how do we develop a wholesale market? Because our job and opportunity was to buy bonds from the retail investors, from Bombay Stock Exchange to Calcutta Stock Exchange to Chennai to all these, even the Ahmedabad and Delhi Stock Exchange, and sell it to LIC and EPFO and GIC and New India and UTI and all of them. That was a market. And the ask was that we need to have DVP, because if you send an RFC bond for transfer on the record date, which you had to do, it takes like a couple of months and your inventory is stuck. So we need DVP. We need reporting platform, because transparency is not there for the secondary transaction. We need some kind of a bidding platform or something for primary market. And the two most critical things are repo, which like supplement the bond market, repo and the derivatives. And over the years, all of these things have happened, right, Jayesh bhai? Sab kuch ho gaya. Humne jo bhi manga 90s mein, almost everything has been done, but we are where we are. I mean, I take the, talking about our industry, I manage the first liquid fund in India. I think our industry has played a crucial role, right from development of the CBLO market to CP market to CD market to bond market. We all launched credit funds so that we can go below AA and we develop the credit market. We launched floating rate funds, all of us, so that we develop floating rate bonds. Investors don't take the interest rate alone, and can there be another for both for the issuers as well as us. All of us worked on the securitization market and overall, but maybe for some or the other reasons, they haven't reached the scale where they should be today. I just give you one number about the debt market, and that's why my ask from the government would be to look at the debt taxation favorably, more from the point of development of the corporate bond market in the long run. In 2016, bank deposits hit the high of 100 lakh crores for the first time. Mutual fund industry, debt funds, including the debt fund and the liquid fund, all of it put together were 10 lakh crores, 10% of bank deposits. Now, mutual fund industry has grown so much after that, but today, the 16-17 lakh crore of debt fund AUM is 8% of the bank deposits. So we have, as a percentage of bank deposits have come down, how the retail interest will get developed? Do you want retail investors to do all the credit research and duration research and all them buy bonds? The better way would be to give professional fund managers like us, and that's how we develop. So my ask would be, we look at larger interest that we need to develop corporate bond market, and what has happened in the equity side, where now you are seeing a $2 billion of an SIP flow, we see something like that. And talking about that SIP flow, by the way, so we have 16 crore folios in the industry, less than 5% are in fixed income. 95% of retail investors are in equity from a folios perspective. So we have a long way to go. I think our industry is determined, but whatever it is, we have to play with the cards that have been dealt to us. Over the next few months, you will see industry is going to work a lot harder in terms of how do we penetrate fixed income funds. Historically, investors somehow have not been comfortable with volatility in NAV, even in the equity. That's why we never had this kind of consistent flow on the SIP. Now, investors are comfortable thanks to all the efforts made by, and some of my industry colleagues are here, on mutual fund Sahi Hai, don't get swayed by the volatility. People are comfortable with volatility on the equity, but when it comes to fixed income, they want that statement that if I am putting 1 lakh rupee today, I will get 1,24,690 rupees after 3 months, which they get on a bank deposit receipt. They don't get that obviously on the fixed income mutual fund. But I think over a period of time, maturity will come and we'll work harder and harder. How do we get that retail interest back?
So even if you don't get the tax concessions back,
I remain quite
for me is
on that,
1 is to a 99% chance that they're going to reinstitute
no, it's still
what they have taken away.
From a liquidity perspective, T+1, from a convenience perspective, from variety of the, you get a diversified portfolio, you get a professional risk management and a portfolio management with a very small amount of cost in a mutual fund, still a very, very good vehicle. But I think the government should look at tax incentive more from a larger objective of developing the bond market
Navneet,
in
I
India.
buy your point. As an investor, even
But
for
I'm
me, it
saying,
is very good. But
even if that doesn't happen,
it
doesn't happen, we will work hard. How do we penetrate ourselves more in retail, the way it has happened for equity?
But don't you think the debt mutual fund guys have largely tapped corporates? They didn't go all that retail. So will that change?
No, but we have seen a substantial increase in the retail participation in equity, right? No, in equity. I think the next leg for the industry, for the growth, will also be on the debt side. How do we, the success of mutual fund Sahi Hai on the equity side, how do we do fixed income fund Sahi Hai? Fixed income fund B Sahi Hai. And you need that also as part of your overall portfolio allocation.
Okay.
I mean, I just tell you about the US. I mean, I gave you that number of India. In US, in last 1 year or so, money market funds have grown by $1 trillion. Bank deposits have come down by $1 trillion. There's $6 trillion in money market fund alone, just one single category, against $18 trillion of bank deposits. It's 1/3 of the bank deposits. And if you take only the current and the checking account, then the percentage is much larger, probably as large. I think in India, the total like liquid funds and all are like 5 lakh crores against 200 lakh crore. Even if you take the CASA of 45, 50 lakh odd crores, we are like very, very tiny. So we have a long way to go.
No, I think there is a peculiar situation in the US because of the way interest rates have moved in the market, that a lot of money has moved into money market funds. We don't know whether this is a longer term trend or it's a tactical play on the part of most retail investors. But checking accounts, yes, I don't think that is in the RBI's or the SEBI's radar at this point in time. That has been an ask many times when I hold debt market seminars, but that remains a distant dream. Jayesh, now to come to you. Let me start with your ask. I mean, I have some complaints about issuers also. But before that, what would you want from the regulator? One of the market intermediaries over here, and she will carry the message. What is your ask to from SEBI and from the exchanges and NSDL to expand both retail and wholesale markets?
Hi. So, Latha, that's very true. We have been chasing this for so many years. I think we are more or less there. I think if you really look at it, of course, my one big ask, if you really want to have an active secondary market, from a primary market perspective, we are very much there. We don't have enough issuers. And as our GDP grows, that will come separately. So that I will talk in a minute about the issuance size. But my biggest ask is not about from the regulator. I would say it is a self-behavior from the banks itself. If you really look at what is competing from with the bond market is basically the bank FD rate. You know, when you have, you know, I used to started saying this 5 years back, 7 years back, like, you know, if we have a market and like whenever we have this kind of conference, I would like to do a show of hand, 8% Government of India bond, 9% Reliance bond, 10% Nationalized Bank FD. Where will you put your money? Your money will go to the bank. If you look at...
But at that time, at least we had a tax advantage.
No, even
now,
with tax advantage, money would still go to the bank, because when we look at tax advantages, mostly HNIs and stuff like that, every family in India would have 1 or 2 people not really paying tax, maybe father-in-law, mother-in-law, or wife, or somebody would not be paying tax. You just need 2 people not paying tax. 50 lakh rupees you can put in an FD and you are not paying tax. So that tax advantage is not really there, right? Because, and how many Indian households have surplus savings more than 1 crore? So from that perspective, if you really look at it, is the FD rate, which is a killer. And that is where, when we always compare with US, right? US, if you really look at banking, is more like a service industry. Even right now, when the money market, that's why the shift is happening to money market at 5% or 4.5% now today. But the thing is, it is still at 0.5, below 0.5. You know, so banking is a service industry. Whether your money goes to mutual fund buys Reliance bond, Reliance pays to the supplier, as long as it remains in the system, the money will remain with some bank.
No, what is your ask?
The ask is the bank has to focus more on service rather than fighting on deposits, right? Rather than fighting on the rates. Now that is a behavioral thing. We don't know how it will change. So once they stop fighting on rates, right, the money will come. Maybe it may go to your bank, maybe it may come to my bank or some other bank.
The US banks also fleece you for services. Okay, one money transfer, they took $75. I mean, what the bloody hell? We transfer in India for $0. I'm not very convinced of the services.
No, the bank, that's what I'm saying. Banking is a service industry. That's what they will get the money. So why are they chasing? The money will anyway come to them. That's what I'm saying. From a deposit side, from a liability side, the money will come. Maybe it may go to A bank or B bank purely on how my services are rated. No. So it will, as long as the money supply in the system, okay, it will change only by RBI. By you buying a mutual fund or a bond or anything,
money supply will not change.
Money supply will not change. Okay, it will be changed only by RBI sucking out liquidity or pumping in liquidity. But that will remain with the bank, right? When it remains with the bank, whether you borrow at 8%, then that means basically I'm just trying to take your deposit to my bank at giving you a higher rate. So I'm fighting with you as a bank on interest rate, not on services. That is what the thing should move. Now that we don't know when it will happen. So that is a situation. In terms of...
My ask is more, you know, in terms of say SEBI or NSDL.
I'm coming to that. So from...
Would you want things like order matching? We've not seen, we have NDA's home, but we don't have an order matching for corporate bonds.
I'm coming to that. So this is a big picture change if you really want the secondary market, and because when you have large pool of individuals coming directly or through mutual funds, right, their demands will change, so there will be always buying, selling. HTM, definitely it will increase, but again, it will not help the secondary market. It will increase the bond issuances, but once it goes into HTM, it will not include the secondary market. So from that perspective, that's one part of it. With SEBI and all of them, my only ask is, you know, today we have multiple platforms. You know, you have 2 RFQ platform, 2 exchange platform. NDS OM, which you are talking about for government security, is only one platform. It's all getting consolidated.
There is no order matching platform, no, for corporate bonds.
Exchange is where order matching started. By the way, NSE started as a debt exchange on order matching platform. I did the first trade on the iconic NSE exchange. So it's
actually... What's the volume today?
No, but that's where it moved out. So that's where, you know, we need to get it focused on one side. But forget exchange volumes or anything. There is no volume in secondary market. It's because of the behavioral, right? Sir, here, there, once they buy a bond, right, they already has an HTM. LIC will not sell when it goes to them. You look at the investors in bonds. So when it goes to them, it is not going to come out in the market. So what, maybe
one minute. Is the fault really that of the banks? I mean, banks are also in the market, and I don't see banks not wanting to attract deposits if they have to expand their business. I mean, look at the position HDFC Bank
no,
was.
fair enough.
when
I'm
they had
not,
to-
I'm not saying if they do
You
it.
can't tell them you can't charge 7% for a deposit.
No,
Well,
if
that was
you
the
do
deal.
that, if you do that, then your expectation for the bond market. See, ultimately, individual investor has a limited. Ultimately, all money comes to individual investors, right? The individual investor has a limited pool of money. Now, he has choices to go to mutual fund. He has choice to go to bank FD. He has choice to go and buy a corporate bond. He can buy a plantation. Situation. Also, people buy. People do all sort of things. So it is that pool of money. Which, and by the way, we cannot also not ignore 22% of salaried class earning goes into provident fund and pension, right? Which is like also debt for them. So 90% of that is getting invested in debt, and that market is growing. So I think our bond market from a primary side is doing fantastic and is growing at fantastic pace. As Sir said, your pension market has grown so leaps and bounds from almost 10x in last 7-8 years. So that's grown. In fact, if you look at demand supply for the bonds, actually, I would say demand is more than the supply as of right now.
Wait 1 minute. Let me switch to Navneet for another issue. We would like more secondary market trading. I'm moving away from IPO to secondary market trading. The point is there are 20,000 ISINs.
30,000.
I mean, 30,000. I asked SEBI and they said, I think it's 20,000. Now, if you have, is it not the responsibility of industry to reissue rather than give new issues every time? And I mean, that's how I see it. But you tell me, what's keeping? There is no order matching because there is no volume. There is no volume because everybody is issuing a new paper and not reissuing. What's the solution?
So in the government bond market, you have like 100 lakh crores of issuance and 100 issues. I mean, roughly, mota moti.
Or even less.
And here in 46 lakh crores, you have 5,000 issuers and 30,000 issues, right? And secondary market trading, if I remember the number correctly, Nipa correct me, I think more than 5 crore is like 50 odd issuers get traded every day, and more than 50 crore is hardly 15-20 issuers get traded. But I think a lot of data has been provided. I think it was Deputy Governor Ravi Shankar or someone I think presented once that if we compare ourselves with a lot of other markets in the world, secondary market volumes are very similar. And because globally, I think the same challenge. You have tens of thousands of issues. Even in the government, by the way, this whole transparency things and all, I mean, Jayesh and I and all of us were on phone market. And I used to have an Excel sheet. Today, I don't see my traders or my fund managers with an Excel sheet of all the government bonds. That I'm selling 807 and buying 1071.16. I'm buying 1071 and selling 605 2019. And constantly trading for 1 or 2 basis points because there were 20 government bonds 20 years back, which were very actively getting traded. In NDS home, Jayesh bhai, 70-80% trading in 5-6 bonds? So I don't think that transparency alone will lead to a lot more trading. I think market also have that.
You should have volume of issuances in one paper.
That cannot happen on the corporate side. I think it's increasing because the reissuance, etc., and the same ISN. But think about a corporate is not a government or a state government, right? They have a reissuance. I mean refinancing.
No, the corporate will be the ultimate beneficiary if there is a very smooth secondary market. But there has to be a concerted effort.
You see another macro number, that the total household savings that go into financial assets is around 10%, right? I mean, how much money is borrowed by the central government, the state government put together? What is left for all the other asset classes is very, very tiny. Over a period of time, as you have more fiscal consolidation and savings increase, there would be greater amount of money that will come to that. And Jayesh bhai was right. 7-8% deposit mein mil raha, why should I kind of like do anything else? Maybe there would be cycles.
Yes.
There would be
So,
cycles when
the
spreads
fundamental
are high.
ask for all bond markets is that fiscal deficit should not be high. If the government comes, and now we are running at a 9% fiscal deficit, if you like.
I think credit to this government, last few years they've been on the path of consolidation. COVID was a once in a 100-year.
Consolidation from 14% to 9% is not very serious.
Yeah,
we
so
should never have
COVID
gone
was
to
a once in
14%.
a century.
This is never-ending debate. I'll tell you, one has to be very practical about it. Except for US, also secondary market volume is very limited. Secondary market volume, but only in US. If you look at every other country, and let's not forget, we cannot compare ourselves with US corporate bond market, right? If you look at every other country, local currency bond issued in local currency, okay, I think from issuance to turnover, we are the top 3 in the world. It does not matter. So what is that? There's nowhere else the secondary market is so active. Once it goes to the investor, it actually remains there. So that's why, from the ask on the regulator side, I would say we should get, and this is maybe it's actually Navneet and their ask, but rather than even in AIF, basically mutual funds, right? Like we had credit funds, fair enough. You actually, you have equity fund, you have gilt fund, you have money market fund. Why can, in the mutual fund format itself, right, have private credit funds, have structured credit funds? Why create a separate AIF and stuff like that? Put it everything into the mutual fund, because then I'm dealing with a HDFC mutual fund. I can shift between my risk asset allocation.
Jayesh, let us end this point over here. I think AIFs are also floated by the same ICICI Prudential mutual fund. So it's really within the same body. If the money doesn't come to the gilt fund or the
Tell me one
fund,
thing. This is the audience which is more financial savvy, right? I can assure you, a lot of them still would not know how to go about it. Where are we talking about the large scale people to go into AIF?
Okay. No, AIF is anyway not meant for, in fact, I think SEBI wants to increase it from 1 crore to 5 crore. They want to make it even more rarer. Let me get to bond market infrastructure. Mrs. Chandru, this is entirely up your alley. What's the, infrastructure improvements that you are seeing that can increase trading and issuance?
As Jayesh said, I think it's a never-ending debate between, the bank's role in the loan market or the capital markets. I think as far as the regulatory initiatives are concerned, there has been a lot of concerted focus on this. I myself have attended many SEBI meetings.
Can you elaborate that blockchain?
Yeah, there was the RFQ platform. There is the EBP. These are initiatives that SEBI has done. And on all these committees, RBI is also represented, which again gives a sort of alignment. The other, I think to attract the retail investors, the face value of the, public and the private placement has also been brought down for the private from maybe 10 lakhs to 1 lakh and for public from 10,000 to 1,000. I think to encourage the retail participation, because we handle 98% of the issues, and we see that 98% of that is private placement only. So unless we bring down that below that 1 lakh, maybe to 10,000 or something, there would be better retail participation. The other recognition or acknowledgement that SEBI has made is the online bond platforms. That also, I think they have been now not, they are not permitted to handle the unlisted part because of the transparency issues. But there would be, better participation if the amount is brought down further from that 1 lakh, because that also means, like he said, the number of people participating would be low. I think there are many such initiatives. SEBI has also, to a point raised by one of the panelists, SEBI is also trying to encourage reissuance by bringing down the number of issues that the company can come out in a year, and also to ensure that there is no bunching of redemptions in a particular year, again the cash flows and other. So I think there is no area of the bond market that SEBI is not or RBI is not addressing, but it's a work in progress. Basically, banks being the major participants, I would think that shift should happen to like LIC or the insurance companies, PFRDA. All these regulators are encouraging their regulated entities to invest in the capital markets. But banks still remain the major part, and for banks it is the asset level that is the main criteria. So investment book is important, but more as a balancing or other income it comes under. It doesn't come under the net interest income or whatever. So I think for the banks to solely lift the burden may not be possible. The ecosystem has to develop like REIT, InvITs and secondary market. Unless that US model is probably somehow brought in. We all were talking of, when I was in the bank, secondary market loan association and all that we were trying to put in place. So that I think would move it to the bond market.
No, I think that point should be well taken, that the secondary market, a hectic secondary market is a US speciality, or if you want to say peculiarity, because no other country has shown that kind of secondary market. So we don't have to beat ourselves too much on that front. We want a secondary market provided, and because it helps corporates get a very fine rate. It must be utility driven and not simply copycat driven. But a secondary market does help corporates to find a finer rate. Mr. Rai, winding up suggestions, what would your ask be? Because you have a responsibility to raise a lot of money for infrastructure. What's the ask? At the moment, it doesn't look like the market is ready to swallow a great deal of infra paper.
Yeah, the existing bond market is only in AAA and AA. My ask will be, it is to go lower, like, higher credit risk bond issuances should happen. There are, there are two products which have to develop. One is CDS, because if you are going for lower rated paper, you need to have a developed market. Regulators are always quite ahead, actually. That way we can't blame the regulator. They are quite ahead, and most of the policies are ahead of us. CDS also, there is a lot of discussion and the papers are already there. But then the market has not developed because that the base product what is required, that the lower rated issuances are not there in the market. So CDS has to come along with that. Another thing what we need is a partial credit enhancement. Because particularly...
Partial credit enhancement is there, isn't it?
It is, yeah, as a policy it is there, but then it is not very viable product.
IIFCL does it. I mean, there are quite a few
They have
people.
done only 1 or 2 transactions 5 years back. After that, actually, actually, like, there are some regulator has brought the product, but it is not very cost effective. See, the basic logic behind this, for a corporate, if they go for a credit enhancement, the kind of savings they do on the interest rate should be good enough to pay the fees. If the fees is higher than that, then why they will go for a credit enhancement? Basically, the capital requirement, which is put by the regulator, basically, what happens is, the regulator's view is, when the credit enhancement happens, nothing changes at the corporate level, at the business model. By credit enhancement, we are only improving the rating, and the capital requirement in the system comes down. So that's why somebody has to take it. So the fellow who is doing the credit enhancement should keep the capital. So that's why, like, the cost goes up. Actually, this is a correction which is needed, which NaBFID has taken up, and hopefully this will be corrected. So these are the two things, actually. If you have to go for low rated paper, CDS has to come in and the credit enhancement has to come in. If that happens, we will see many more issuances happening in the system. There is enough supply of paper. Like, again, linking back to what you started, HTM. Tomorrow, if there is a big appetite, see, now banks are only looking at credit growth. When you are monitoring performance of the bank, you look at CD ratio. How credit is growing. Based on that, you are to assess what is the return on asset and all that. Now the time will come, you'll also look at the investment book. Because the STMs will have so much of investment, which is much beyond G6. So now, that kind of returns also will start accruing to the banks. That's a model change which will happen next year. And they will look for more investments. But then they need to have these two products also to supplement this, so that it is an orderly development of the market. Because as Mr. Giridhar said, we don't end up with default situations and the LGDs are quite high and kind of thing. That's why we need to have that mechanisms in.
The fair point, CDS and credit enhancement have both been, bandied about by the regulators, but tweaking of the rules is certainly an important ask. Any winding comments from you, Mr. Giridhar?
Here, one is going below this AA kind of, that is one. And second is the public participation. Third is what kind of an exit route that it is available for the corporate bonds, if at all somebody is taking a position.
What kind of?
Exit route that is there. It's kind of a, a lowly rated papers are the paper. So there was a talk that, there will be a fund will be set up, and so this...
The backstop facility, but that is only in times of crisis.
Absolutely. So there must be a confidence. One is at what rate, suppose take the case of a retail investor. So now first step is, this 10 lakhs has come down to 1 lakh, but is that okay, whether it has to be brought further down in case of NCDs? And in case of public issues, it is 10,000, then denominations of 1,000, all that fine. And second issue is what kind of a valuations that we are talking about. Yes. Okay, so valuation is a very important, so take the case of an equity or GSEC. Yes, it is dynamic during the day, fine, but there is a valuation that it's only time sensitive, but it is not a issuer or rating is the analyzer sensitive. Okay, there is only one screen that keeps moving up, so the way you enter. So it is an administratively very simple thing. Okay, so during the day the price is dynamic, fine. But where is a valuation in case of a corporate
The
bonds?
point is taken, sir. For CRISIL is the valuation provider for mutual funds, and maybe there should be a cross-industry valuation benchmark.
Absolutely. And always we keep seeing, whenever a major issue, say, okay, one is the matrix based. Again, the moment a deal happens, an issue takes off, again the matrix get corrected. Automatically it had to be get corrected with the previous day's deals. So when a matrix is driven by the market, obviously it has to be. So the secondary market also should be more, the weightage has to be given in case of evaluations. Because ultimately what happens, when I do my M2M analysis, take it to the profit and loss account or whatever it is there, ultimately when I go for liquidation, I should be in a position to exit at the price at which I have valued it.
Yes.
So there, again, I should not get stuck between
there
two.
the need for a secondary market is very much there,
Absolutely.
so that you get an exit. Nipa, winding comments. I think there are questions from the floor. So this is the last interaction from the days. Any winding up comments in terms of, asks from the regulator, or even if you see better trends for FY25?
No, I think, over the last, if I compare a year on year or a last year to this year, and, I think we've gone pretty wide based on the amount of things regulator has done. Of course, the question always becomes that will there ever be a vibrant secondary market, because we've not seen that in the other countries. But if there is a way to do it, I feel some of the OBPP platforms, also the ensuring that the face value is lower, some kind of repo platform. So at least I think there are, and the kind of, retail investor interest which has been procured by the trustee rule. I think there is a possibility if there is an interest for the market. Of course, equity has always been darlings of retail investor in India, but I think the number of investors in debt are much lesser, and even if we see some participation, I think that liquidity can come in some form or the other.
Fair point, sir. We're all waiting for that.
By the time you take a question, I think our regulators have done a phenomenal job in creating a world-class infrastructure. As far as trading is concerned, settlement is concerned, reporting platforms are concerned, disclosures are concerned, we are absolutely next to none. I think India will probably be the only country where all mutual funds follow like one bond, one price. I don't think any other country would have been able to achieve what we have been able to achieve. And with the new infrastructure that we are building between MFI and under the guidance of SEBI, like the backstop facility, limited purpose clearing corporation, and many other things which are on the anvil, I think we are up there. Up there. Yeah.
Okay. Well, the cruelty of so much interaction from the days is that the organizers are asking me to cancel the Q&A, which is really very cruel. One question permitted. I think it's unfair to take away the rights of the audience. A question from the house. Okay, no? Fine then, we have not transgressed on the time. We have ended on time because the audience has been kind to the speakers. Thank you very much, Nipa, Mr. Giridhar, Navneet, Jayesh, Mrs. Chunduru, and Mr. Rai. I think the key takeaways, ultimately there has to be more savings, and savings will come from higher growth. So that is a longer term India story which is greatly encouraged by yesterday's number of 7.6% growth. A growing economy will mean growing savings and growing investments. The other asks is, for me at least, from the mutual fund industry to goad retail investors into debt mutual funds. I think you'll have done a wonderful job in equity, but I request you all to do the same thing in debt. And finally, corporates. We will have Mr. Y.S. Chakravarti and Jairam Sridhar on the days. I think the issuers will have to reissue rather than bring in more new issues. That's the ask from the corporates. Thank you very much, gentlemen and ladies, for an excellent participation.
May I request you all to please stay with me on stage. Ladies and gentlemen, the offering that all of you have been waiting for, the moment is here. We are all set to launch the Compendium, ID CMS 2023, an exploration of the Indian debt markets journey onwards and upwards. May I please request you all, please stay with me on stage, Latha Venkatesh, and all our esteemed panelists, please stay with me on stage. Yes, for the launch of the compendium, please. Please take center stage. Our honorable moderator and panelists, I request Nipa Sheth to kindly lead the proceedings of the compendium launch. We're also joined by Mr. Utpal Sheth on stage for the launch of the compendium. Congratulations. As I said, it's a compilation of the journey onwards and upwards of the Indian debt market. Ladies and gentlemen, we also have a soft copy compendium that we will now launch in your presence. The QR code will be projected. Stay with me on stage, please. Please, all our esteemed panelists, moderator, Utpalji, please stay with me on stage. Stay with me on stage. Stay with me on stage. Thank you very much. We will now launch in your presence the soft copy compendium. The QR code will be projected for you on the screen. This has a compilation of 145 issuer profiles, very valuable information for you to make use of. If not, from the screen, ladies and gentlemen, the QR code is projected across the venue at your own time of convenience. Please do download the soft copy compendium. Here it comes. Can we have the QR code on the screen, please? As I said, we have the QR code on different boards across the venue. You could download at a time of your convenience. May I please now invite on the dais Abhishek Kedia of the Trust Group to present mementos to our esteemed panelists and our moderator. Please join me on the dais. We'd like to say thank you to Mr. Jayesh Mehta, and this is the